Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Jeff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you are tuning in with us, thank you so much for joining us. Be sure to go check out all of our content that we push out into the investing universe. Best way to do that is to go to focuscompounding.com, click that blog section, and have the ability to type in any topic that's on your mind and get access to information going all the way back to the early 2000s. If you want to follow me on X, which is the best place to get everything that we push out regarding the podcast, you could do that by following me at Focus Compound. All the information is in the description below. So today's podcast, Chef, I want to talk about gross profits, gross margin, and almost their predictive ability on future stock price movements. Not only that, but also on analyzing the business. Talk about different scenarios where you could have companies that look like they are left for dead. And it's cool. You could go back and look at it and be like, yeah, things looked a little bit on edge here and that, they didn't look so good. However, if you sort of go up that income statement, you could see that the overall business was improving, right, from a gross profit perspective. A lot of investors focus on gross margins, but that doesn't always tell a case, right? Like you could look at a company like Amazon, for example, and say, oh, at a certain point in their history, they had low gross margins because they're just looking at that actual number. And it may not tell the full story. So before we do that, though, Jeff, we were talking about this off air recently. Palantir Technologies. Have you ever seen a company trade at a 118 times price of sales, right? So as a general rule, you always talked about, look, you can go your entire investing career and be perfectly successful, never investing in a company trading 10 times sales. So what about something that's 10 times your, general rule? Are you really playing with fire here? I mean, what's going on? Hey, I don't even know what this company does, right? It's sort of the black box, government contracts, AI. Supposedly the government can't run without it. You could put the tinfoil hat on and say, oh, Peter Thiel and blah, 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 right? But I mean, goodness, 116 times EV to
Yes.
sales, 118 times price of sales. What's going on here? Have you ever
I
seen a
don't even
company
think
this
I've ever.
expensive?
Yeah, I don't think I've ever seen a chart that even calculated how many companies were selling above 20 times sales. That's the most I've ever seen is like tracking a bubble. 10 is what I've used, but they'll sometimes be charts that are like, are there any companies over 20 times sales? Yeah, I've never seen it this is a $370 billion market cap. So I've definitely never seen it with a big cap stock that it's been at this price. I mean, because you compare it by revenue to other things, and obviously they're much, much smaller. They're much, much bigger companies that are normally that size, or the market cap of companies that have 3 billion in sales are often a lot smaller. You could, if you kind of comped to what those are, this is not a large company that way, but some things do grow rapidly. We talked about Celsius on this podcast, years ago, and that did grow rapidly. So it kind of grew into being more of the same size as what you would expect from a high price to sales. This one does have really high gross margins. Doesn't have super fast growth right now, but I guess it's expected to have super fast growth in the future.
Yes, definitely. Yeah, and on the topic today, yeah, gross margins have improved. But it's like you're getting into this point now at these valuation levels where it's like, okay, like what percentage of the economy is this company, going to represent, or like what could it grow into? And at some point, isn't there sort of a ceiling there, or is this just like an infinite TAM?
Well, I mean, I guess the addressable market is any, well, it could even be beyond what I think. It could, I mean, no one would have thought an addressable market. You mentioned Amazon for that, involved Amazon Web Services and stuff eventually. So you can go into other things, I guess, with the technology that, you didn't know you were going to originally. But yeah, it's big anyway because technology used by friendly governments and stuff could be huge. So it could be big. Yeah, it's one of the top spending areas for most Well, not most, but it's a large spending area for several governments.
Yeah. Are you familiar with their CEO at all? He's a bit of a
Uh, yeah.
esoteric guy.
Mhm.
One thing that stood out to me, one thing he said, he doesn't drive, so he doesn't have a driver's license. And they asked him why, and he said because I was too poor and then I was too rich, so he never got
Mhm.
his driver's license. But yeah, obviously large language models, and they do a lot of stuff with the government. And yeah, crazy though. Look at that, 119 times, 118 times price to sales. So
Yeah, but it
their
does have
revenue
the
growth, the revenue growth, like, yeah, it's a lot, but I mean, it's not like it's 100% per year
no,
to
it
come
looks
up with
like a
a crazy
great it looks like a
valuation.
great business. Yeah, it has the right margins for having really high gross margins, and they went up for at small size, and it has really good revenue growth. But we talked about, well, so it looks like a FICO or something, but we talked about FICO at 1/10 the price to sales. I thought was a lot. So, but it has the things that you would need, which are very very high gross margins and increases in revenue without necessarily having to have increases in assets and things. So it has a business model based on the numbers alone that would make it a really great business. This one that we're talking about is just size issue. So that could be true for any of the ones we talk about. We can talk about how good or bad a business it is, but then there's the issue of how big can the business get, and those are two separate things. Some businesses can get really big, but don't have the economics that they're going to make a ton of money. Some look like they'll make a lot of money, but you don't know how big they'll be. This price is just on a handicapping basis. It's just hard to make the stock make sense, even if the business shows quantitatively really attractive things, which it does.
So before we jump into gross profits, I wanted to pull up a article that you had wrote back in 2012 from the Gannon archives, which obviously is on our website, focuscompound.com. And you're talking about gross profitability matters more than most investors think. You said it's not necessary for a company to have high margins. It's certainly not pricing power to achieve truly remarkable returns on capital. And it's definitely not necessary to have high net profit margin from the business's earliest days. But you do need some basic evidence of a strong business model. And you say, what is a strong business model? There are countless qualitative ways of looking at a business model. Gross profits divided by receivables plus inventory plus PP&E minus payables plus accrued expenses. This number should start looking good and keep looking better pretty early in a company's history. Look, Amazon is an expensive stock and it's got low margins, but it also doesn't tie up capital in the business.
Yeah, this is a long time ago. This stuff isn't true anymore. The business changed from that. Yeah, so it might be a much less attractive business in the future, but that was true at the time. So when it was growing then, it would have been able to fuel a lot of fund its growth and everything. Now, these companies today, it's a different story. The Amazons, the Microsofts, the Metas, they are investing huge amounts of capital, which they weren't doing before. So that changed. But that article is from when the
Yeah,
businesses were
2012.
different than they are today.
It's a good way spotted earlier, though, is what I'm saying.
Yeah, no, agreed. But I just mean the business models of all of them are changing dramatically, so they may no longer have very high gross returns on the assets they have because they have a lot higher assets. They shifted from being like asset light and doing work for other people to investing in their own assets, which is fine. A lot of companies do that later in their life and their profitability declines, but obviously they funded themselves from the part where they had really high returns on capital.
So you've talked about like gross profit per share before as
So.
a interesting metric to follow. Most investors don't follow that. So can you take us through, your line of thinking there and why that's something that you think people should track and what it means to the company?
So, in the long run, return on equity and things like that are really important to stock returns. And one reason that countries like the United States have historically had higher returns is how they are funded. So they're funded through retained earnings. The companies become profitable early on in their life. They are then don't have heavy borrowings that they have usually. And then they also don't issue a lot of stock once they're public. So they go public and people get rich on IPOs usually in the United States. But once the companies are public, they don't, except issuing some stock to insiders all the time, they don't fund their operations a lot through a lot of stock issuance. And borrowing a lot of money and issuing a lot of stock are kind of the two things that cause a problem in some places where the country has good growth, but the owners don't get it. So like you take China or something, great, amazing growth for the economy and the workers who live there and everything. but not necessarily great returns for people who just own stocks there, as opposed to countries that have almost no growth because of that reason. And so, Buffett talked about ad agencies as a gross profit royalty. So what he meant by that is that basically advertising is funded out of gross profits. It's kind of like a selling expense that they would have, but you need to have a profitable business on that basis before you can invest in trying to grow the scale and all those things. And there are accounting issues about why this could be misleading, because if you just focus on this but didn't really understand the business, things could look better or worse on gross profit because of how it's kind of calculated. And we took an extreme example. I had mentioned FICO. We just looked at a stock. The gross profit thing is kind of complicated because there's probably almost no variable cost to them. So they invest in a platform of some kind to do something, and then they basically probably are using most of the same thing for one customer after another after another. The investment is really in having a capability, and then they're providing that capability to the customer. And it would not radically change if they have 1 or 100. Now, their selling expenses might. They might need a lot more salespeople on commission doing this or that or whatever. But like the actual direct cost of providing the services is not high. So you invest in something and then you hope to sign up enough people, right, to like make it justified. So those are hard to judge, as opposed to the ones that are more easier for people to imagine. The gross profit is like your supermarket. That's very easy for people to understand. Okay, it has a 25% gross margin. That's because it's marking up this amount and then it costs this much to run the store, that kind of thing. But it helps a lot with scale, because early on in the history of a company, a lot of companies, people will say, are not profitable. Why are investors investing all this in this company that isn't profitable? But the business model looks like it is profitable, but it hasn't scaled up enough. And in some industries, they might even seek, for competitive reasons, especially, to try to grow even when it's kind of dangerous to do that, funding wise, because they want to be, like we talked about big tech things. They felt they had to be number one, that there wasn't gonna be a lot left over for number 2, 3, 4. So they have to get big fast to do that. And there's other industries where it would be similar, where they're concerned about competition splitting things up. And then there's other ones where they're just, people really want to get rich really fast and they think the business model works. And so they open up a lot of new locations and everything before they actually show the profits from it. And companies invest a lot in that all the time doing that. Buffett's talked about like Geico. They don't make money when they first sign someone up, but they have good retention over a long period of time. Anything that you look at from a Home Depot or whatever, probably when they first open the store, doesn't make sense. But the point is that it's not this year's earnings that they care about. It's that for the long term, it makes a lot of sense. And so when you can analyze that other ways besides the financial statements, but if you're going to do it in the financial statements, the best way is to look at gross profit. The other way is to understand the business model, the kind of like, store level economics and all that kind of stuff. But there's no unbiased information about that. That's a management presentation you can't reliably check yourself usually.
Mm-hmm. Mm-hmm. How do you think about so when you're talking about Home Depot, is that more of like thinking about it from like a customer acquisition and Geico customer acquisition cost? What is that to the company? How can you retain them? And then how does that math work out over time?
Right. So it's investment. So all these things involve an investment, and the best businesses usually, well, we talked about ones that are different. Big technology things and stuff are different in that they invest a lot in capability that then they don't customize to each customer. But a lot of other businesses invest a lot in the customer relationship. And almost always that doesn't make you money in the beginning when you have that. It's not worth it. So, and sometimes it's not captured by the financials, but like if banks want to attract commercial deposits or something, it could take them 3, 4, 5 years of calling on that prospect, trying to get the business, and then they finally get it. You don't see that in the financial statements so much, but obviously that's what, that's business development type stuff we're talking about. And so they have to do that to then make a lot of money for them. For stores and things like that, it's usually investment in the area, and then you have to grow awareness, but it depends. So take restaurants. Cheesecake Factory, when they open a location, they get almost everyone that they're ever going to get right away. Historically, like that wasn't their problem, is awareness. They had high awareness. Other places, a mom and pop thing that opens up, it's going to take it a little while to build awareness in the area, and so then it's just a question of getting up to capacity. There's other things that could take years to do that. So you build out a new warehouse. We talk about this with like distribution companies and stuff. If something decides that it needs to be able to have more capacity, then when it first adds it adds it in a big chunk. There's no way for them to add 1% capacity to what they have. They have to choose to add 20% or something if they only have 4 or 5 warehouses. So then that's not going to be profitable until it absorbs that capacity. And then like theme parks and things, it would take them 5 or 6 years to get full awareness. So they're not going to get their money back until later on those things. And the gross profit part of it is a lot of it goes to investment and selling expense. Usually it's what can justify it. If you have good gross profit, then you can justify a lot of selling expense, whether that's salespeople or spending a lot on advertising or something. If you have poor gross profit, it doesn't make a lot of sense to spend a lot on advertising.
Why do some companies then, like sometimes they'll have a negative gross profit and they're scaling that? Is that just purely like for the customer relationship and scale advantages, and they think over time that they're gonna just grow out of it? I mean, I've seen companies do that before, and it's like, I mean, I think about gross profit as, hey, does this business work, right? Is there a business model here? But I have seen situations where they have a negative gross margin, and it's like, wow,
So
you're kind of 2 feet deep or in the ground and trying to claw yourself out. It's a really hard way to make money because you can't.
So there's 2 possible reasons why that would happen. One is if you're a middleman type business and you expect that you'll eventually have scale, which will give you bargaining power over others, and then you'll be able to use that. So MoviePass thought that that's what they were going to do. Now it didn't happen, and they went out of business. And then the movie theaters, who really did have the power, just implemented the same plans and stuff for themselves.
It's a good idea. Yeah.
So their idea was like, we'll pay people and then take a loss on that. People will pay us less than tickets are worth. We'll buy the tickets. We'll lose money on it, but we'll grow to a big enough base where I think really their hope was like advertising and stuff. But we'll have this customer list and we'll be able to use this both to say to movie theaters, oh, we won't, you have to give us a better price. And so we can bring this down, or to like advertisers and things that we have this list of people and you can, use it. And then on the other side of that, you have so let's give an example with like tech things, for instance. So it's a bargaining power thing between the two of what I mean with a middleman. It doesn't just have to be like distribution or something. So a good difference on that is, why is YouTube so profitable and Spotify not? Because Spotify has to buy content that it has to use, and it isn't in a strong position to bargain for it and everything, whereas YouTube doesn't. So YouTube can make a lot of money to the detriment, relatively, of the creators, whereas the creators can't really be taken advantage of in the same way versus Spotify. You could say the creators taking advantage of them or whatever, but basically you have people who create things who then have, publishers, agencies, things that are able to sell entire catalogs and things. And so you're not going to make a lot of money in music, for instance, but you will by, these videos that we put up, Alphabet can make a lot of money off of them from us, because we're not in a position to get as high rates for ad time or something as we would if we were part of some group that bargained on our behalf for that. So basically people will give them free content, so some idea that will change. Then the other possible reason is highly volatile inputs and outputs. So that happens. Refiners and stuff can just completely lose money in a year, or like if it's very short cycle, it's fine. So eggs are the traditional example of that. That's a super short cycle. Yeah. So it's fine to lose money in a year, to have no gross profit, because it'll rationalize quickly. Hens that lay eggs don't live for that long, and you can produce more of them really fast. So it's not like something that, if it's in an imbalance where you have overcapacity or shortage, that's going to last for too long. So, every 18 months or something, you're going to see this violent cycle that, when it's really profitable, people should start doing things that causes the profitability to come down, and vice versa. So it's okay to have years where you just go, I'm going to lose money because it's so cyclical. And so, but it's such a short cycle, I'll get back out of it.
Yeah. I mean, for people listening, you could have years in negative, or you could have years that are 8 figures in operating profit. But then you could have years that are in the billions or close to it in operating profit for Calm, the short cycle nature of it, just swings all over the place.
Yeah. And so like in their defense, so you have a year there, 2017, it says their gross profit was 4% margin, which meant that their gross profit in dollars was $46 million. So obviously they lost a huge amount of money because it costs a lot more than $46 million to run the business. In their defense on that, though, it could have looked perfectly fine. I don't remember everything about 2017, but because you could say, well, people are always going to want to buy eggs at some price. But, supermarkets are going to want to give them to their customers, have them available there. So that makes sense. And they might have known that competitors were losing even more money than them. Like they might have had competitors who had a negative gross margin or something. So if you knew your relative position was fine, it would be okay. Now, if you were the highest cost producer or something, then that would be a different story because yes, people will need eggs, but they don't necessarily need your eggs. But if you're the most efficient way of getting them eggs and just there's no money in eggs in 1 year, then that's life. And, there used to be 100 years ago, a lot more businesses like that in the United States that were in businesses where you might have to accept that you would lose money in some years because it's a pure commodity. And even if you're the low cost producer, supply and demand, you're going to have boom and bust years. You're going to make a ton of money in some years with amazing gross margins, and then you're going to have some years where your gross margin is nothing.
I want to talk about like gross margins and how they drive the multiples in some stocks and businesses, right? So I guess before we jump into some examples, why do you think? I mean, I've read some quant studies that show the best indicator of future momentum in a stock is gross profit momentum, right? So growth in growth profits. Why do you think that is?
Well, so there's a few possible reasons. One, moving up the income statement is good for getting closer to the actual business realities, right? So that's one part of it. I think that the issue with quant things that we're talking about is that obviously they wouldn't know, or they seek not to know. I mean, you could see it other way. Things about the business that would be helpful that aren't captured in the financial statements, basically. So, I mean, they might look at some other things that aren't in the financial statements, but basically they're looking for publicly available information that is comparable and quantifiable to everything. So they don't have color on things. So the gross profit's probably the best number for that. It would become a less good number if people paid too much attention to it, because you could definitely manage it from a management perspective. Management probably does goose sales and probably does goose income, or in a lot of cases EBITDA, because those might be things that people are looking at, but is less likely to be focused on gross profit. And then in terms of the things that it does with what we were talking about with the indicators that it has, if you imagine putting those aside, the biases of what management could be doing and how the number works, just if everything was prepared properly without the idea that they knew they were a public company, it's really helpful. Because there was a book that kind of talked about it's one of the better books on investing stuff in terms of explaining where value comes from, which is basically that you have to be able to charge more than others for your product, and you have to be able to pay less, which there's all sorts of different ways that could be. You could pay your labor less, you could do whatever, but that gap is what makes businesses profitable, and that is captured earliest in gross margin. And so an improvement in that is kind of like an improvement from the perspective that you're getting an indicator that customers value this more highly than it costs you to produce it, which is what you need to know. But venture capitalists and stuff maybe don't need that number and can kind of speculatively say, oh, I see what you're doing, and this is going to be really valuable to customers when it's out there and everything. And so they can do it earlier, but a quant can't do that. So, that's the underlying truth you're trying to get to, is whether you can take something that costs you a low amount and charge a lot for it. And gross profit is the first indicator in like public statements. That's the case.
So you could think about couple different scenarios that could drive a multiple, right, in a stock. So it could be consistency, right? And we've spoken about before how Costco is probably like the purest form of that, right, of consistency. So I have it up here on the screen. So I mean, gross margin, obviously it's not high, right? Back to our earlier example, but it's incredibly consistent over time. And Costco trades at an insane multiple, right? And then the other factor that can drive a multiple re-rate or multiples higher is just, of course, the growth in gross profits. And we could talk about like a company like US Lime, for example, where gross margin went from, call it, low 20s to, over the past handful of years, we're close to 40 on average, right? If you average that out.
Mhm.
And the multiple re-rated, I mean, basically more than doubled, I believe, which we could pull up key ratios, and let's see. You could see price to earnings. Yeah, I mean, basically have doubled over the past 5 years.
Mhm.
Another example of that could be a company like Buckle, which is an interesting one. This company always came up on like screens, like Magical
Mhm.
Formula screen or other like high quality screens, and you could see that revenue growth hasn't been anything spectacular, right? Zero point 0.5, so less than 1% 10-year CAGR on revenue, but gross margin has held up and only improved or done okay over time, and return on equity has done good as well. And the stock price movement in Buckle has been okay. So want to get your thoughts on sort of the difference in from a consistency level, right? You used to write the Munger newsletter of Guru Focus, or you're
Mhm.
part of that, and things that you screened for. But then actually the growth in gross profit, which could drive that multiple. And
Yeah.
maybe that's
So
where more of our listener base is going to focus, because I don't think a lot of investors that follow us are probably going to buy like a Costco at 50 times earnings. So maybe if you're going to get that multiple expansion, it's more of the improvement side of things.
yeah, and so, but again, with the thing of looking at just the numbers versus knowing a little bit more about the business helps in these cases. So if you take the gross margin at Costco, you know that their strategy is they don't want the gross margin to expand. They actually want, if they could plan perfectly, they want the gross margins to stay the same. Their goal is to take on the benefit that they would have, that they could have a higher gross margin, and then pass on to customers, which will drive greater revenue growth, which, and then through that cycle. That's their model. Other companies might not do that. If you talk about Buckle or something, they don't think that they could sell more and more you know, jeans or whatever fashion things they might have, because there's a limit to that. Whereas Costco wants to sell everything possible in huge quantities to the people who are members, right? So it's a different model that way. Whether you want to make sure that you keep pricing high enough, or your profitability high enough, or whether you want to have something where you're driving as much value for the customer in terms of just like low cost, which is their model. So theirs looks more like, I mean, I think in recent years, Progressives doesn't look like that. But if you could see things, that would kind of be the goal of both a Costco and a Progressive or something. Their goal is not to make wider and wider margins over time. They feel that they miss if they price too high and actually had too big a margin. They would rather that be similar over time,
That's
because they
this
feel like if,
scale economy share model,
yeah,
right? Nick
because they
Sleep
feel like
has been about.
that everyone will buy one auto insurance policy, and they could, if they had too much profitability, it meant that they could have had more market share than they do, basically, right? So they're balancing those two things against each other. Whereas someone who's Rolex or something is not going to think they could sell to everybody, so they want to make sure that they have a certain amount of profit on everything that they sell, and are okay if that gets wider over time, probably. That's not the case with the ones that we just saw there. um, but in terms of like what would cause it to widen out, that's pretty easy for some companies. The question is how early you would be. So US Lime, you could predict that. It could have an explosion in gross margin if you researched the industry, the company, et cetera, or even just read some things the company said, because it was operating at so much less after the financial crisis. It was producing so much less output than it was capable of, right? So when something has capacity utilization basically of like 60% or something, but is making good profit, well, that means, if it goes to 95%, it's going to be making a ton. Or the other thing is whether it's like monopolistic, in the sense that people won't necessarily, its customers won't necessarily be able to get any relief in case of inflation and things like that, right? A good example of this, I think, is I think they still have it on QuickFS. It's no longer a public company, but Encore Wire, WIRE, is that what it was? Yeah. So this is a good example because you can see it through 2023. This company knew it was a super low cost, very efficient producer, deliveries on time at really low cost, and it had like the model that worked the best that way. But if you can see, after the commodity boom kind of busted right around the time of the financial crisis, all the way till almost COVID in that graph there, being the best producer in the United States got you like a 10% return. Like, so most assets in the industry probably weren't even justifying, being public or using owner money. This company was maybe barely doing that, and it was doing it at being very efficient in terms of costs and everything. Now, what that meant is that it exploded once the price of copper went up, basically, and other things. But once there was, and especially an expansion in it, not just like it being a high level, but if it was going upwards, that would have a dramatic increase, kind of like when we talked about banks or something. Like if they're very efficient but they depend a lot on the net interest margin, then it's only once the rates are higher for some banks, and then for others the yield curve is steep, that they make money. We talked about that, basically Frost in the case of higher interest rates, and I think we talked about Hingham in the case of steepness of the curve. If you're kind of a low cost producer of money, but you just make all your money on the other side of it, of what you get paid. And if you don't get paid a good price, then you're not going to be making money. But you could tell in each case that if the value of the commodity as an output that they were positioned for happened, then they'd suddenly be making a lot of money, and vice versa, that if it collapsed, they wouldn't be.
Mm-hmm. I want to go over like growth versus profitability and just different, three different scenarios, right? And we could talk about it. So Lead Corp, if you're a microcap investor, I'm sure you're familiar with this company. But strong revenue growth over time, but gross margins decline, and the stock underperformed, right? So look at 2015 right here. And again, people listening that may be more familiar with the business, maybe you could say, oh, where they did this or they did that. I'm not, here to debate that, but just looking at this from like a high level overview right here. Um, uh, Gross margins in 2015 went from about 52% to 40%, even though revenue went from 18 million in 2015 to 44 million in 2024, right? And the stock did not do well. Another example, we could look at Boston Beer right here, grew revenue much faster, but failed to grow gross profit per share. And the stock, drastically has underperformed. That's like an interesting chart. We should pull up Sam right
Boston Beer is a
now.
really good example because I wrote the stock up like 13 years ago, and everything that I wrote up about it turned out to essentially not be true. It would have been true if the business and the company had stayed the same. But as an investor, you invest in a company, and if they change their product mix, pivot into other industries, whatever, that's the return you get. And so they ended up being a much faster growth, much lower profitability company because they went into things that were different from what they were in initially. When I was talking about them, they were primarily, really, really primarily, just like a Sam Adams, like what they call better beer type category, of higher priced beers. And then you talk about spiked seltzer and all that. I mean, they had Twisted Tea and stuff by then, and Angry Orchard stuff, but like that expanded, and they became in a lot of other categories that were different and had much faster growth. And in terms of volumes and stuff, they were probably selling a lot more. But in terms of gross profit, like we talked about, not so great. And certainly, I mean, they grew, but not amazing for all those years. And then gross margin obviously declined. Yeah.
Mm-hmm. So for people
and return on
listening,
capital declined. Yeah.
for people listening on the podcast, so in 2015, revenue was 960 million and gross profit was 502 million, 52.3% gross margin. In 2024, revenue basically doubled, was just over 2 billion, but gross profit was 894 million, and it was a 44.4% gross margin. And even years before that, a few years before that, it was actually a lot less. So operating profit, which is interesting, even though revenue doubled from 2015 to 2024, operating profit was basically the same.
Yeah.
10 years later at 152 million.
Yeah, and if you look at this one, and you'd only see this in the video, but it's the really key part is the 2018, 2019, 2020, 2021 fiscal years. Because what's interesting about those are the difference in the revenue growth, which looks quite strong. And my memory is that caused the stock to go up during that period. Actually, the multiple expanded during the 2018 to 2021 period.
Oh yeah.
But
Wasn't that like
but
the seltzer craze where
yeah,
I think
yeah.
we could throw on here a
And
metric.
it
I
really
remember
became
we
crazy
talked
with
about this
COVID.
high.
I mean,
Yeah.
yeah, obviously that changed everything. But if you look, each year they have like double digit type revenue growth, but each year they have fairly dramatic drops in the gross margin, where the gross margin is going from like 51% to 38% at the end of that. But every year gross margin is coming down. Yeah.
Like
So
it's
it
for
peaked.
people
Yeah.
listening in 2021, it looks like price to sales was like 9 times.
Which
And then
is
it
interesting
drastically fell to
because
1.1 today.
yeah, as we said, the gross margin contracted from 51 to 38. So we don't have the calculation here, but price, but like enterprise value or market cap to gross profit actually went up even more than price to sales, because sales was justifying that kind of growth, but gross margin wasn't. And then after that period, actually, they probably, I don't have a lot of details on the company and know everything about it, but in the period after that, it actually looks like it returned more probably towards what it had been before. That part probably shrank, the other part probably grew. And if it hadn't been for that period in between, if we had just had a snapshot of the company before and after that 2018 to 2021 period, it might actually have looked much more the same, though they ended up in a worse position, obviously. Operating profit in 2024 was the same as it was in 2015, which is not great usually unless you bought back a lot of stock or something, because there was a lot of inflation. So in real terms, it's about 2/3. Actually, it's probably a little less, 2/3. Yeah. So it kind of contracted by about 35% as a company in terms of how much money it was making in real terms, probably.
So as an investor, what is the scenario that you would prefer to invest in? Sort of the low cost producer where maybe it's more about scale economy shared, customer satisfaction, and more of like a volume play versus maybe less volume, higher prices, more of your craft beer, more of your Rolex versus, name your favorite cheap watch company.
That's a great question. The way to make tons and tons and tons of money, as we've seen recently, is in the low cost, huge total addressable market. I would prefer the opposite. The number of things that historically that have survived for long as on the low cost approach is not high. So we'll see.
And just so I ask, do you believe though with the high price point model, right? You have to be much more familiar with consumer and customer taste and sort of the behavior there, right? And feel comfortable with that and feel comfortable with it not changing. Versus the other side, well, the customer and consumer preferences is cheap prices. And it's, everyone's always going to like that. That's never going to change.
No. So I disagree on that point, in that I think that usually how you have very, very low prices is you have an extremely fit system that will be wiped out as soon as there's a change in how something's delivered. So the problem that you have is you develop this thing that is the absolute lowest cost way of getting things from here to there, selling them, organizing them, whatever, and then something changes where people actually have another method of getting that, and your system no longer benefits you. And so that's really dangerous. So like if you were offline and you had this extremely elaborate system for how to have the lowest cost in stores, once online comes in, that can potentially change that. If you had an approach that was based on reaching customers a certain way in terms of advertising and selling to them, and then that changes, then you have a real problem. So I do think that low cost, it depends. If you have low cost, deposits of some mineral that's going to last you 50 years, then that's very safe. But usually it's low cost distribution systems that it really could have a problem pretty dramatically. You even see that in things like Geico versus Progressive. I mean, Geico had a model that was based on attractive customer acquisition, and then some things within that about, to some extent, selection. And Progressive had one that was based on pricing correctly to risk. And you saw pretty dramatically how quickly Progressive was able to profitably take a lot of market share from them, because certain things changed in terms of technology and stuff that made that ability scalable in a way that suddenly you could take a much bigger advantage of it. And so that worries me. So like, yes, I know that people feel like, say, Google or something, right? Let's put YouTube part of it out, but the Google part is very safe compared to, like I said, a Rolex. But AI and stuff, if people get AI answers instead of typing something into a search thing, if people go directly to Amazon and have an AI suggestion of what to do as they're shopping instead of going through Google, if they do different things with travel, with whatever, they're dependent on a lot of those things for advertising. It might not be valuable to people anymore once that happens. I mean, newspapers were once a very cost-effective way of getting your news, and then they no longer were. And there are not many. So you take the most extreme examples, retail, where efficiency is what matters the most. They have an incredibly high extinction rate. So there's people who've gotten rich off them, then sold them, and then put their family's money into something else. But if you just like kept your family's money in something, and that's all you owned and stuff, you didn't create something that was wealth forever that way, as opposed to brands and things which have a much longer existence, that are more agnostic in terms of distribution. So. But so if you're asking like just what are your odds that you'd be able to survive forever when we're comparing, this is happening in streaming things. Netflix did better than Disney, but which was more likely to survive and everything? Disney, because of the content and everything. It could be agnostic about that. Eventually there'll be some way to distribute it. Someone will pay you for it. You can create your own channel. So it'll work out. Netflix had to race to make sure they got big enough, fast enough to survive. And then they've done great since then. But also everyone who tried to do another Netflix lost money. So, I mean, if it's a home run, if you're right about it. But the other thing is, if you are on the low cost one, there have been examples where it's been reversed, but you probably want to get out pretty fast once that starts going the wrong way. Like you wouldn't want, I mean, that happened with Southwest. We went over that in one podcast where he said, look how big the gap was, and then look how it went away. If that's an insurer, if you used to be able to save people, you had 10 points of advantage over other insurers or something, or you had a better operating ratio and things with the airline, because the airline's a lot like insurance that way. You could pass on to customers and you could do great. But as soon as that gap closes, you don't really have anything to offer. And that has a tendency to happen. So most of the low cost type businesses, don't last forever, I would say. They have a tough time that way. And even ones that do are often single site or something. Like even when I said retail things, the retail, honestly, if certain department stores and stuff had never expanded to owning other stores outside of the original ones they had, some would have done okay if their location did okay. Nebraska Furniture Mart or something is different than like Walmart. It's a bit safer.
Mm-hmm. Final example that we can show here, Waters, right? So it's sort of the opposite story of the first two that we spoke about, slow revenue growth. So the first two were, high revenue growth, but solid gross profit per share growth. And the stock, I mean, it did okay. I mean, not necessarily, I don't know if it was market beating, right? Now the past few years, obviously the markets have been super strong, but the business itself did pretty good. We could pull it up against the S&P. S&P crushed it, but let's see over the past 10 years. Yeah. So opposite story though.
Ones like that. Well, one problem that you have with that, I don't know, that was always an expensive stock. So I'm not sure that it was even cheaper 10 years ago. But the other factor that you have there is actually just that the gross margin is very, very consistent. So you have a situation in which, and this is what we're getting to with profitability. So the quant stuff, like quality is often, profitability, quality are often considered the same, and then growth is somewhat separate. This is a company that has strong quality numbers, but not growth. The best situation is a high quality company that is high growth. High growth without quality is rare and dangerous. It doesn't usually last that long unless you have some funding source that's that isn't your own earnings. Mm-hmm. Yeah, but any company that grew really fast and got really, like any company that's giant today usually has something in its past, in the United States, at least businesses that were private sector and everything. There's usually something in its past where it had a really good run of making high returns on capital. Otherwise, it wouldn't get to be the size that it is. The actual business, not the market cap, right? We started this off by talking about a business that's a $300 billion market cap, but it's only a $3 billion revenue business or whatever. If you're a $300 billion revenue business, at some point in your history, you were a really good business because you somehow funded a lot of growth. Now, there is one other exception that we should bring up, which is the return on capital thing. There's a weird thing, which is some businesses don't have moats around them necessarily, but people think they do because they have high return on capital, which could just be you're the first one in, or there's shortage or something, and could last for a few years and then go away. So it's a longer term thing of that. And then the other weird example we have is some have funding advantages, which are probably not, they're good to have, but they're probably not as attractive as having good gross margins in terms of what it means. So somehow you've been able to whether it's lease the thing or get the customer to fund you or something, which is always a good thing, but it isn't as strongly indicative of a good business, even though it has really high returns for owners as like having gross profit. Because gross profit basically means that, you're doing something right in terms of what value you're able to get and give on the supplier and customer side, so that there's a gap there that, you can make money off
Make
of.
money.
Yeah.
Let's talk about gross margins or gross profit and gross margin as like an early signal, right? You've always said that you worked for a guy that was, he would do a lot of stuff in technology and like Internet of Things, right? And he would always tell you that if he was ever in a company and their gross margin dropped like quarter over quarter, he immediately got out.
Yeah, right? So for his own investing stuff, because he invested new technology things, invest in that, and just knew from technology stuff that you only want to be in a tech company when its gross margin's going up, and as soon as it starts to go down, you have to sell it. Yeah.
Why is that? Explain that logic. Like play it out. What usually happens after?
Sure. So there's a few different things. So one is with tech things. So we talk about like supply and demand. It's no longer in like short supply. So there's enough of it to go around, which could be that other people want to, could be that things are changing technology in terms of how it's being used. It could be the competitors getting better that way. It can also be company wide. You're selling less new stuff and selling more old stuff, so this is the Phil Fisher type stuff. The other way of doing it from the quant side is how many of your products you came out with this year, 5 years ago, whatever, and Phil Fisher, that depended more on getting honest answers from people in the company and around it and everything to build the same sort of thing that we're talking about. Whereas some people's feeling is just whatever the company's saying doesn't matter. If it's a tech company and there's a decline in gross margin, it means that those things are happening, even though they're not telling you. Yeah. It's not as hot a product anymore. Tech and fashion have some similarities that way. The hope with tech is that it's not a short-term thing, that it keeps being the case, right? That you have this great technology and you're going to keep that edge. But whether it's the same thing with like fashion merchandising edge, that because we think of a fashion cycle as that happening. It's the same sort of idea. You want that to continue. It has to be the thing that people want, the fashionable thing.
Yeah, it's like BlackBerry when the iPhone came out. You could cut prices to keep revenue coming in, but if no one wants it, margins are going to absolutely collapse.
And that gives you a good idea of the technology thing, because while that company was incredibly profitable and had magic formula type stock and all of that, to like losing money was a very short period as opposed to most businesses. That's why I mentioned fashion. You only see that in like tech and fashion things. Like you have people can't explain why some teen retailer or something went from being the most profitable to like losing money in 2 years, and you don't understand it. Same thing happens in tech things too. Like what happened with the iPhone and BlackBerry and everything. Yeah. Same idea. It's a huge switch. Everyone switches from one thing to the next.
Let's talk about Carvana. So, basically look like roadkill, but gross profits did, keep improving, which is obviously what you would want to see if you're ever looking at a turnaround situation or where you're extremely worried about, an impairment or something like that, right? Saw this tweet. So we had obviously wanted to talk about Carvana on the podcast. And then I woke up and I saw this morning and I thought it was funny. Carvana was down 98.99% from 2021 highs. It's now up nearly 9,000% from the lows. And he said the stock market is wild. I mean, that's pretty crazy. Think about that.
Yeah. Although that's flat if you owned it before and after. We have to do the math of that for people so that
yeah, like
down
right
99%,
here. Put a trend line right
9,000%. It's in the same place.
Yeah.
Yeah. So, I mean, let's look at the company-wide things, because I just know something about the unit economics from years ago, but which is kind of why I mentioned it to you a while ago, is that this was one of these cases where it was interesting because the companies basic economics seemed like it wasn't impossible that this could make sense. So I've looked at companies like this, Chewy, some other ones where you go in the early stages, management saying one thing, you could look at it one way. It might be possible to make money on each order, but it's hard to know. It's very attractive for customers if this is true. And Carvana is very, very good deal for customers, good experience for customers. I mean, people should sell their used cars to Carvana. Definitely. I would recommend it. But I would recommend MoviePass, and I took advantage of MoviePass. So that has nothing to do with whether the business is any good or will survive. I mean, you could obviously, it's very easy to offer people something that they would prefer than to make it a profitable business. So, but the problem of that was scale, right? Was always the question of how quickly would it scale and keep getting better. And that's the point that I was mentioning before, where you asked, like, why would something have a negative gross margin? Or in Carvana's case, I don't know if it was negative, but in 2015, 16, 17, as a gross margin of 1% to 8%. Car dealers might have something almost as low as 8% if it's like a fleet thing, and something maybe on like actual car sales, I guess. So they don't make a lot of money on new cars, but this is company wide. So the reason why they would sell you a lot of new cars or something is because then they get your business for service and other things. In those years, what Carvana was doing is not something other dealers would want to copy, because they would just think you couldn't make any money off of it. That's too low on amount of, that's too low in terms of how much profit you're trying to generate. And then, as you go on, you can see, let's see the gaps there, so that until they eventually have, a big improvement into the actually operating profitability in 2024.
Mm-hmm. I mean, what happened during these years? We're familiar with car prices and dealerships and what happened. Maybe take our listeners through that.
Okay. So some of it's complicated because of accounting rules. Some of it is somewhat misleading. If we looked at cash flow things, the economics were worse, and they were closer to bankruptcy than those numbers would suggest. They're probably very, very close. Because I mentioned this once about Tesla. There's a period where like margins expand or something, people were impressed during COVID. If there's lead time between when you make something and when you're selling it, and there's inflation, that margin doesn't exist. So there's a period here where there's a gross margin it's phony. There's no, if you went and replaced the car, you sell a car and then you turn around and you have to replace the car, but you don't have enough money or cash to replace the car. Now, if you have certain credit arrangements and stuff, which dealers do and stuff, then it's a little more complicated than that. You only have to replace part of the value of it, because most of it's being provided by the dealer and by the like floor plan financing and stuff. But basically, if it's an all cash business, there's a period there in which you are selling inventory and you don't have enough money to buy more inventory because cars have gone up in value more than your markup on the car. So that's an initial period there in COVID that's happening. That let's try looking at the cash flow thing to get an idea of what I mean. On a cash basis, the business wouldn't have really been generating at that point. And so, because you can see, cash from operations is significantly negative. In fact, the most negative ever, right? From 2019 to 2021.
Yeah, the story went from, we're improving, and then in 2021, 2022, it went boom, like just complete.
Yeah, let's see. But we have net income, so we can compare to some extent. I mean, net income is not the best measure for this, but you can compare to some extent what I meant about the cash in relationship to the income and everything, in that it's significantly worsening, because before all that, let's say take 2017 as a clean measure. Your net income was negative 160 million, and your cash from operations was a use of 200. Okay. A few years later, your net income is not that different. It's like negative 365, negative 462, negative 287, but you've now tripled or worse your cash flow from operations in terms of the burn that's happening there. So the quality of the earnings has deteriorated during that period. And that's a weird thing to say because they're reporting losses, but it's even worse than the losses they're reporting at that time, the reality of the business. And then later it changes. And then you have positive cash flow from operations in the last couple of years, 2 years, basically. Yep. Mm-hmm. And significant cash flow. Yeah.
And the stock is up 9,000% off the bottom. But back to
Yeah,
where
well, we talked about quant things. If quant could come up with a way to predict when the market will think something's about to go bankrupt, and yet there's a high probability it will not even probability. There's some decent possibility it won't go bankrupt. That's the best thing that's the best inside information you can have in the market. People always talk about like, oh, there's gonna be a choir or something. No, the best thing you could have is like, ahead of time that someone's gonna restructure a loan or something, and everyone else thinks they're about to file for bankruptcy on Friday or whatever, which is what happened here. Yeah, if you could tell the difference between things that are going to be bankrupt and Chapter 11 and those that are going to recover in some way, even if they never get remotely back to where they were, that's going to make you a lot of money.
Let's talk about to close this out. I mean, don't want to bring it too much back to fashion because I know that's harder to judge, but CROX, this is a company that's talked about a lot recently. Gross margins obviously very good, have improved over time. Trading like a home builder. So, what's going on here? Is this a fad or is it a trend? What is it?
Yeah, I think that's a good way of putting it. And I think that's the same sort of thing that you see with home builders, same idea. So, I mean, you'd say, oh, what does Crocs have to do with a home builder? But it's kind of the theme of what we've been talking about today is that what does technology have to do with fashion or something? The issue is how do people differentiate between this is a trend? So all these things, when you have good margins and expanding gross margins, there's a trend. And that's kind of what we talked about with the quant things. Momentum wise, the business momentum is great. Let's not even worry about the stock price momentum. We're all agreed on this. The question is, are you too late? Is it about to turn? Those sorts of things. Is it sustainable? The best thing would be if you have, business momentum that's expected to be sustained for a period of years or something. Because even if you're not going to own the stock for years, there'll just be good news the whole time that you do own it and then sell it, But here you see the multiple is low, right? And so people have doubts. It has, good revenue things. There's been years where gross margin is higher, but it has very high gross margin variability, so I wouldn't worry that much about that. There's no trend towards worse gross margins in the last few years going into this. Now there might be. Now we could look at quarterly and stuff, but that would be the obvious thing. Would be people's concerns about that, yeah. So I mean, yeah, quarter to quarter there's declines, but seasonally there isn't really. So yeah, you basically, I mean, I won't tell you whether you should buy the stock or not, but I think you can tell in the case of Crocs, and I think you can tell in the case of home builders, that there's an expectation that the future is going to be worse from a supply demand case. So in other words, like this is kind of there's maybe they don't expect Crocs to become an even bigger trend. Let's put it that way than this right now. And they don't expect home building in terms of inventory and stuff probably to be a better situation than it is been recently. I mean, because otherwise they would put those multiples much higher if you just look at what the results are.
And then Deckers, another popular company, hookah brand name. That's what I wear. Got a pair of hookahs. Yeah. Kind of could see in your just everyday life how much that brand has taken off, right? It seems like everybody wears those. But another example of, so revenue growth has just been incredible. But also growth margins and gross profit growth has been incredible. And you could see, right, how much that has scaled from like an operating margin perspective. So probably SG&A as a percentage of revenue has gone down, right? And that's what you want to see when you see companies growing a lot.
Yeah, and you can see there the multiple is much higher. So presumably people are more optimistic about that one. Yeah, we could you have like
versus
Nike or one of those, because those are the ones that are the losers to, Nike in particular, I think, has been the loser to some of the trends that you were talking about that people are probably more concerned about. Some of the more recent ones in the running shoes type space. I don't know if people are really running with them, but that look.
Yeah, we got Nike pulled up right here. You could see, revenue growth, 10-year CAGR 4.2%, but gross margin has been falling 46% in 2016 to 42.7% in 2025.
Yeah, I don't know the business. This is always one that amazes me in terms of the price that it has and versus what its results have been recently. Obviously, it's famous as an amazing business long term. Yeah. Because you're looking at something that's, let's see. Well, okay. Yeah, no, that's right. So okay, so the peak profitability was the last few years, not this most recent year. So if you price off of that, it's more like 20 sometimes, like record earnings, probably 20 times or something. So the P isn't as bad as it looks that way. So it could bounce back to where it was just a few years ago. But what's the market cap on it? The EV, if you could just.
EV 112
Okay.
million.
Yeah. So, I mean, even if you look at peak, it's certainly over 15 times and more like 20 times pre-tax, what it kind of peaked at in terms of profitability. So even if it got back to where it was just a year or two ago, you know, that it's not a cheap stock. I mean, it looks kind of expensive for a stock that's only grown sales by 4% for 10 years and hasn't grown EPS at all, although it did until this most recent year, I guess. So.
I mean, Deckers versus CROX. I mean, what's the difference here? Why does Deckers trade at a higher multiple, basically double what CROX trades at?
That was my point. My feeling on
More
that
than
was the
double.
same, which is why I mentioned home builders and stuff, is that value investors look at these things and go, oh, Crocs is so much better than Deckers, or oh, this particular home builder is so much better than the other one. Where you want to be careful is we could say it's clear that something's priced into the differences in terms of people who think they know something about fashion, let's say, or think they know something about particular home building markets or whatever, that there's concern. And that could clear up. They could be thinking, oh, things are about to be really lousy and they're not. I mean, like 4 months ago, maybe like 5 months ago or something, you saw things in the stock market that indicated things around travel, anywhere from 3 to 5 months ago, travel, tourism, spending by certain things like that were all like, there was concern about it. And then the kind of, as the year went on, it seems like the market's not concerned about the kind of consumer spending. So the same thing can happen with any prediction. Here, they're probably concerned about one thing's fashion versus another. And I'm sure that's why we mentioned the home building thing. It's the same thing. There's certain markets where people are concerned about what they see in terms of inventory or something.
Mm-hmm. I mean, it's hard to, I mean, you look at like Crocs and you see that they're selling like charms for the shoes and be like, huh, that's kind of interesting.
Yeah, that's a really big part of it, of the whole thing. I think over time for them, that's helped them, is creating that kind of like Pandora, the jewelry company and stuff. Building up a whole thing around what it is for the for people to buy more of them and to be more loyal customers and to be a certain kind of buyer versus some of the other things that we're looking at. So I always find that hard to analyze. Yeah.
I just wonder if they look like, do investors look at Crocs and say, oh, it's sort of, single thing. And then maybe they look at Hookah and say, oh, they're trying to become more of like a platform company, right? You got UGG, which is obviously super popular.
Well,
Shout
I
out to
will
Tom
say,
Brady. And
I will
then
say
you have
this.
Hookah.
Honestly, there will be a strong tendency for investors to overvalue something like those shoes that you're seeing there, the running shoes and stuff company, and undervalue a Crocs. This is something I've noticed across my whole time investing, and it's definitely very pervasive. If you have something like AI or something, investors don't understand it, don't whatever, but they can, or it could be biotechnology, it could be all sorts of things. If they don't understand it, but it's not something that's just not to their taste or fashion or whatever, then they may give it a high multiple. If it is something that's very appealing to a group of people, they are not. It tends to have a low multiple. So that's one thing that you just notice. That's almost universal. If investors tend to be from urban areas and things, and this is a rural thing, the rural thing will be undervalued relative to the urban. If they're male and it's almost exclusively about female, then it'll be that way. I mean, there's just one thing after another where I've seen that generationally. There's all sorts of things. So, yeah. And that's what I mean about fashion type things. So when it gets into things like this, there's an idea of like, this makes sense to me that people will buy this product. It doesn't make sense that they would buy that product. And that's fine. But the one thing you want to ask is like, well, does that reflect your tastes? Right. Because that's the important thing there, is to make sure that, it isn't affected by that.
Maybe
So.
these two should just get a room and merge together, solve everyone's problem.
Well, yeah. The interesting thing about it, and this gets the gross profit thing, is does it solve it? So there's companies that have done this. You put together lots of apparel things, or you put together lots of shoes or whatever, right? What was the one, the best example that was well, actually there's a couple examples in apparel. But I was going to say like which is North Face and all those things, and then and so the point is, as you get each of these brands, you're often buying, it happens a little in restaurants too. You're buying a brand that's supposed to be faster growing, have better, more attractive things at the time you buy it. And then over time, as they mature in what you own, they don't look like that anymore. You know what I mean? So like a mature brand isn't as profitable in terms of being able to charge a lot for it and stuff as a hot brand. And so you have a tendency to put together things that are hot brands at the time that you bought it. And, but over their whole life cycle, they end up looking like the brands you already had, you know?
Very interesting. Very interesting. So I guess this scenario right here, right? I mean, CROX, because of the price, you think would be more interesting to you? Or is this more of a fad?
No, I would think that anything that I think I would have these sorts of quantitative numbers that look good. And then I think I have some edge that's not quantitative in would be something that would be attractive. And then in the vice versa cases where I think other people who are buying the stock know more than I do about it. Yeah, but I wouldn't just be contrarian to be contrarian on something like that. But I did mean that seriously, because like when you were talking about the charm things and stuff, yeah, for people who have the shoes, they know all about that, and that's a big part of it, is being able to do that as an expression of things that they're into and stuff, to put that all in there, which other shoes don't have and don't seek to have. So it does differentiate it in an important way. It doesn't mean that it's not a fad, but I just mean it's different. It's a highly differentiated product, certainly. Yeah.
It's kind of like Keeley's, right?
Yep, which is a fad, but a highly differentiated product. Yeah. Waterbeds, highly differentiated product that no one uses. I mean,
bringing them back. Bring it back. Waterbeds. My grandparents had one. Awesome.
You know, so
I think my grandma developed back problems because my grandpa was heavier. So she'd be down and she'd be like up in the air, you know? But whatever.
Mattresses are a really good example that way, because we've cycled through so many different ones where we have to come out with a new technology, new way to market it,
new business model,
margins on it,
negative gross margins.
Yeah. And so whether it's Purple or Tempur-Pedic or Sleep Number or, where we talk about going back to waterbeds and things like that, it does allow you as a technology / fad to have high margins at the time that you're selling them then. And then once it becomes mature and it's just like everybody else has a knockoff of this, those margins go away. And so we have to kind of reinvent that, sort of thing. It's like it's kind of like if you had a drug and it was under patent and stuff, and then it's a generic now, you got to go find the next that's not a generic to, fix up the portfolio.
Would it worry you to be like, we have a new way of distribution, a new way of marketing this product that's been around for a long time and has just like always never worked from like an investor standpoint?
Yeah. So, I mean, this is where we talk about it. So, I don't
like Carvana was not that. Carvana, okay, like dealerships have worked and are very profitable, can be very profitable. And this was a different way for that.
Yeah.
Versus mattresses.
I mentioned venture capital things before. Don't do any venture capital investing, don't know anything about it and stuff. But if I had no numbers to go off of, overwhelmingly, it would be, is this a product that sells itself and doesn't have good distribution now? Versus is this something that has good distribution? I'd be much more interested in something that the product seems to have a good sales proposition, but has really bad distribution. And the question is just, can we get it in certain doors? Can we get an affordable way to sell this thing to people and bring it to them? But when they see it, they'll like it. But if you're talking about, everything's great, but in a focus group, they really don't like this product, then that would be the one that I would avoid. I would much rather, it just has really good, like we were talking about movie things before, right? So Princess Bride got one of the highest ever scores with exit audiences, and it didn't do that well in theaters, right? But it had a long life on distribution after that and stuff. That's the kind of thing that someone in the industry would be like, I'll buy this from you. Like, even though it opened poorly and stuff, because we know that it had one of the best ratings by people who actually saw it. So the problem was just marketing. Marketing is really important, but if you have a product that people really like, but just doesn't have good marketing, or we talked about Celsius, just wasn't in a lot of places. And so it's just a question of getting to more places. Will it sell more? You've already had it proven. That's the Peter Lynch kind of thing of like, I feel like these companies don't go private at such an early stage, go public at such an early stage as when he saw them. But, it's in a town. It's got 8 locations. They're doing great. It wants to raise money so it can then go to the next town in the next state. And, whether that's a La Quinta or a fast food thing or whatever. That's the best. It's got proven numbers on the really basic numbers.
Unit
The
economics.
business model. Yeah, the unit economics. Yeah. Mm-hmm. And yet it's not showing up yet in the statements. Yeah. So what we talked about here, it's showing up in the statements, but it's at least showing up at a much higher part of it. So maybe you're early compared to someone who's looking at the bottom line by looking closer to the top line.
Cool. Good job out of you, Jeffrey. Well, I want to thank everybody so much for tuning in with the both of us on the Focused Compounding Podcast. Make sure you hit the subscribe button wherever you are listening or watching us to be notified every time that we upload a podcast every Friday from here on out. Be sure to follow me on Twitter, or X, formerly known as Twitter, at Focus Compound. And of course, if you're interested in learning about our money management services, you can reach out to me at andrew@focuscompound.com. I'll thank everybody so much for all the support, and we will see you in the next podcast. Take care.